folks. Welcome to Sunday Night Futures Live. Please let me know if my audio is good here. I just replugged in my mic, and I want to make sure we are good. Good. So what we're going to talk about tonight are obviously the futures action. We have a real busy week. Earnings coming up. We have jobs coming up. We have the ADP coming out midweek. Then we have the jobs data, what I like to call the Pimp Mac Daddy of them all. Non-farm payrolls coming out on Friday. And then, of course, we have the Fed meeting along with earnings. We're going to be talking all about that tonight. A lot of catalysts, a lot of potential binary events, whether they be earnings or economic data coming out this week. Watch volatility. Volatility is going to be, I believe, higher. So let's get to it. Let me share my screen and we will. How's the audio, guys? Is it all right? We will get started. The futures are open. Okay. Let's begin. All right, so we have a gap up. This is a 5-minute chart, E-minis. And we're up, but we're fading off the high of the session. We're up spot 10%. You got to expect a little bit of a give back here. I mean, Friday was a pretty strong day. Let's take a look at the NQ. This is the NASDAQ 100. Hold on, Jeff. I'm looking at your note here. Sounds like computer mic, not regular mic. It's probably the webcam mic. Let me check that out. Audio output. It says it's my standard. Let me know if this works better. Does that work any better? Thanks, Jeff. Okay, let's let this settle down for a moment. Let me go through some hellos here. Mike, Bob and group attendees. Hello, Mike. On the video, always trying to play call options in it, certainly on watch. One of my favorite trades for this coming week will be in the video, no doubt about it. I love it. I think we had a breakout on the day, on the week. I think we're going to do a little bit of retrace. And on any retrace, I'm probably going to be buying some call options myself to the long side on the video. Always trying to play call options, certainly on watch. Fabulous trading action last Friday. Yes, AI sentiment and upcoming earnings on top. Yeah, so I think it's really like it's a valid point that you bring up. I think that it's the perfect storm for NVIDIA right now. You've had Google come out, Microsoft come out, strong reports, all AI. Also a reminder, you have SMCI coming out this coming week. I believe it's on the 30th. They'll be reporting. That's an AI play as well. Very volatile, thin float. Be very careful. It'll rip your face off. So back to NVIDIA for a moment. We have enough time to put on a long position between now and their earnings report, which is like probably a little over a month away. So we have time here. So I think I like the trade quite a bit. I think that it is the $1,000 mark on NVIDIA. I think is like a diamond jig to a barracuda. Traders want to see it. They want to touch it. They want to feel it. Buy earnings. That's my prediction. That's where we're going. So I will be long with you as well. Okay. Pete, welcome. Franklin, welcome. Amazon earnings on Tuesday, April the 30th, and so the FTC has some negative news. The FTC has been active of late in their antitrust action. Okay, Franklin. Thank you, Franklin. Okay, cool. Thanks, Mike. Okay, you got it. All right. So let's get to the futures. So the E-minis have settled down here a little bit. It looks like we're setting up for a higher low. We did not fill the gap. Mid caps, they are down fractionally. Where am I? Where's the NQ? NQ. NQ up 0.07%. Not feeling a lot of excitement here. Let's check out the Russell. This is the same thing as we saw last week, where the Russell was doing better than all the big caps, which is very surprising with yields so strong. I took a look at the mid caps before we went live, and they're not looking all that good. I'm not a buyer of the Russell here. I think that it's going to be a bit of trouble. We're going to talk about it in a moment. Let's check out yields. So now we know why we're getting a little bit off of the rut, because yields are down. The however is, and granted this is only a 5-minute chart, they gapped us down. They filled the gap. This is a reversal candlestick. Not much to talk about, really, per se, yet. But if it shows up on a 15-minute chart and we break out, then that's going to be something to talk about. So let's set up an alert here. Create alert, single. Higher high. Okay, so we're good to go. All right, so yields down, equities up at the open here. Let's check in with the currency market. The dollar it's showing up. It's up relative to the normal hours session, but relative to the after hours session, it is down. Now, the reason for the strength in the US dollar is the weakness in the euro. The euro is down at current. On the week, it did close up, but is this a bear flag setup? We don't know. Way too early to make that call. Now, the fact that the euro is basically range bound, right? So that's going to give the dollar some room to run, because what don't you have? Well, what do you have, I should say? What do you have is the Japanese yen that's in free fall, absolute free fall. Their inflation over there is through the roof, getting worse, because their currency is, in essence, collapsing. Their debt to GDP is over 200%. You think we're bad? On a relative basis, debt to GDP, they're worse than we are. The government owns most of the bonds. They own about a third of the stock market. So the Japanese are in serious trouble. They did one rate hike a few weeks ago. We haven't heard anything out of the Bank of Japan. It didn't work. So they're going to need to fire off a bazooka to stabilize their currency. And what you may be seeing here is money leaving the United States, being repatriated back over into the Japanese markets. So that could cause us some problems if we continue to see decelerating Japanese yen. So this could be a problem. There's rumor out there. I have a tweet up that the Chinese may be devaluing their currency. I only heard it from one source. Usually I like two, but it's out there. So that's not fact. It's just a possibility. Now, taking a look at gold. Gold down fractionally here at the open. Let's go back to the 5-minute chart. Let's take a look at silver. Silver down 0.25%. Moving on to energy, light sweet crude. Crude price is down 0.33% at the open year. Nat gas. Now, nat gas, they're gapping up, of course. It flashed a bearish reversal bar on the week last week. So I'm a little bit worried about nat gas. You know, it's so volatile. They call it the widowmaker for a reason. So we booked some profits because I just didn't like the way the week closed out. Now, if they smack it down hard and do another retest of historical lows, which we're not that far off of, then I would step back into the long side because we're in a range right now where we've seen some big bull runs in natural gas over the course of the past decade or so. So I'm not going to rule out re-entering the trade here, but as it stands right now, I think it's just best to see how it trades this week. If it doesn't follow through, let me show you the candlestick that I'm talking about. If it doesn't follow through with I'm not sure why this is showing like this. Let me show you another view. Continuous contract. It's probably factoring in after hours trades. Ugh. Yeah, let's just bring up oil. Oil is a leveraged product, putting you long of nat gas. And while it had a volatile week last week, ultimately it flashed a bearish reversal bar. So that's a bit of a concern. So what I want to do here is just take my crayon out. If in fact we close above this support level, I'm back in. If we pull back and do a retest of prior lows, I would probably step back in too, assuming that we do not break that prior low. So natural gas up in the opening session here, but way too early to get reinvested in it at current. Now, sticking with commodities, I want to go with agriculture. Now, corn, you know, we've been talking about inflation for a while, right? We really don't rely upon the PCE report. You know, we knew it was going to be hot. We meet every Sunday. We talk about commodities. This is what we do. We know that the energy prices have been moving up higher. We know that agriculture prices are moving up higher. If you have high energy prices, they can back it out of the core all they want, but there's still the input costs of manufacturers go up due to the fact you have distillates that are being included in their products. Those prices are rising. Case in point, you're a tire manufacturer. What are your major inputs? Oil. You need petroleum byproducts to make rubber tires. And if oil goes up, well, guess what? Your prices are going up as well. Inflation going up. So we talked about how cocoa prices were driving up the DBA, the Invesco agriculture ETF. We're going to go to a chart of cocoa in a moment. I think that rally is done. It's over in the books. It's cooked, gone, no mas. However, one might think that now the DBA, which is 10% cocoa, is now going to pull back, which it did last week. But what happens when you have corn breaking out now? And we've been talking about this. We've been talking for weeks about this setup. It was in the bear market. We put in a higher low. We drew this line last week, and now we have broken out. Check that box. Corn looks like it wants to go up. Soybeans, check that box. We spoke about this last week. It broke out. Wheat, massive week last week. So this is no great surprise, none whatsoever, that we have agriculture prices moving up higher, oil prices moving up higher. We don't need the CPI report. We don't need the PPI report. We don't need the PCE report. We don't need import prices, export prices. We're looking at the commodities themselves, and they're screaming prices are going up. Yet, the mainstream media, they want you to believe they're going to cut rates soon. While I believe they want to cut rates, they can't cut rates. And if they do cut rates, inflation's just going to go through the roof. What else do we have to go over here? RBOB gasoline prices. Weekly chart looking good, threatening a breakout. We're down at current. Live cattle making a bit of a comeback. I think this is a bear flag setup. While pretty, I just think it's a counter trend rally, and this gets resolved to the downside. Let's throw up an alert here. Okay. So we are good. Let's check back in with yields for a moment. So we have a little bit of weakness here on yields. That sets the stage for a potential rally, continuation rally in the equity markets, especially if you have oil pulling back. Yeah, looks like they want to try to take this up higher. So let's do this. Set up an alert, create alert. Higher high. And while we go into the news that could impact the markets, let's set an alert just to get made aware of if we put in a lower low. Okay, good enough. All right. Okay, so last week, the equity markets had a really good week, really good week. It was not a good week for shorts. Dow Jones Industrial Average closed up over a 0.5 percentage point. This is not a great candlestick setup. To me, this looks bear flaggish. In essence, what we're doing is we're just setting up for another rollover here, in my opinion. I'm not married to that idea. We did add on strength to shorts last week in anticipation of potential pullback. Volume to the upside was good. Let's check back in with SPY, weekly view. Up over 2.5%, an inside wake, no new high, no new low. We did not break through resistance. Volume on the week, not too good. Think about it. We were up 2.65%. That's a big move, but there's no volume. So this is not institutional money that was fueling the market up higher. A lot of it was short covering. And when you take a look at a daily chart of the SPY, it kind of makes sense, because what happened here a few days ago was that we were in a very tight downtrend channel, very tight, too tight. So you had to get a release here of this energy. We got it. So now this question becomes, do we break out or do we fail and roll over? To answer that question, or to weigh your odds of whether or not you're going to be right on a short here, you got to ask yourself the question, why did the stock market rally from October the 23rd to only a few days ago? Why did it rally? Why did it put in new all-time highs? There was a promise made. There was a promise made by the Federal Reserve to the average investor who is now net bearish on the market. This is the retail investor optimism, now negative for the first time in quite a while. And this is a contrarian indicator, but simply because we go negative doesn't mean you should be bullish on the equity markets. Remember, 2022, we were bearish all year long on this chart. Yet we had a bear market in equities. So the Federal Reserve, where's my CME Fed Watch tool? The CME Fed Watch tool, they had March as a foregone conclusion that we were going to get a rate cut. March come and gone. April, they're going to meet now. We're not going to get a rate. We're not going to get I should say it's actually May. May, we're not going to get a rate cut. It ain't going to happen. This was 100% probability at one point in time. Now it's 2.5%. Maybe they'll go in June. This was 100% at one point in time. No. Now it's down to 11.8% probability of an ease. Maybe July. Surely July. No. Now that's only 25.4%. Maybe September. That's 50-50. At best, you're getting right now a probability of a cut. Maybe September. I think that could only happen for political reasons. They need to try to fuel a market rally here and do an emergency rate cut ahead of the election. If that doesn't happen, I don't think that they go for a rate cut till December. There's a problem with that. If the Federal Reserve is cutting rates for non-political reasons, then they're responding to something very bad. What is it? Because we know that usually the first rate cut is the top in the stock market for several months. Why? Because the Federal Reserve has got to drop those interest rates all the way back down to zero again. But the spending in Washington, that's going to continue unabated. So the reason for this recent stock market rally is simple. No more rate hikes. That was enough to get the markets excited. Then a few months ago, Powell said, hey, rate cuts are coming. Inflation is looking good. Then, now it doesn't look so good. That PCE report that came out on Friday was shockingly hot. Yet the equity markets rallied. Why did they rally? Google, Microsoft. Simple as that. Can they follow through? I don't know. I think that this earnings week is going to be very, very critical. Let's talk about economic data coming out this week. We have nothing on Monday. That lends odds for a continuation move up higher in the equity markets. Why? No real news, and plus you're looking forward to earnings coming out. Amazon, a lot of names coming out this week. Tuesday, we get some inflation data, employment cost index, some more inflation data, the Schiller Home Price Index, Chicago PMI, Consumer Confidence, 10 a.m. report. Be careful of that. Don't forget about it. Wednesday, the precursor to non-farm payrolls is the ADP report. That is a jobs number, construction spending, ISM manufacturing, very, very important number. FOMC rate decision, we know that's going to be a binary event. So in short, we know they're not going to raise rates, and we know they're not going to cut rates. It's simply going to be, what does Jay have to say? Simple as that. Thursday, initial jobless claims, U.S. trade deficit, productivity, factory orders. And then, of course, on Friday, we get the pimp MACD of them all, non-farm payrolls. Watch out for this one here. U.S. hourly wages. As an American, I love to see my fellow American make an extra buck. The Federal Reserve is not of that like mind. They don't want to see you making more money. That's inflationary. Let's do some comments here. Okay, Mike. Few semiconductor AMD. Yes, they're coming out this week. Yeah. I bought LAC, which did an offering of $5 shares. Okay. Joel, everyone waiting for owner's equivalent rent to come out and core CPI. Yeah, that's the biggest joke going. Owner's equivalent rent. SoFi is on the run, which is up after hours. They had a great earnings report last quarter, I remember. Talon, hey, Talon. Good evening, everyone. Bob, how much will the market be affected by the Philly? I don't know. I think that there's way too much economic data coming out right now. You're asking the right question. You're asking the right question because it's a serious question. The last I heard, the Fed's lending facility, for what Talon's talking about is that you had a bank, a regional bank out of Philadelphia that got seized on Friday afternoon after the close. Why? Liquidity concerns. So they don't exist anymore. You'll remember that this happened in March of 2023 in earnest. Lots of banks were going down, regional banks. But the Federal Reserve created a lending facility. And up until the time that lending facility expired, those banks were using up that lending facility to stay afloat. Now, yields don't appear to be doing anything except for going up. Why did you have the regional bank crisis? You had the regional bank crisis because yields were going up. And then these regional banks were forced to buy all of these treasury bonds at yielding 2%. Their loans are at 2%. They're not making money on these bonds. They're not making money at all. They need to sell those treasuries back to the Federal Reserve to free up capital so they can lend at current market rates. So they have serious liquidity problems. They did not structure their portfolios properly. So now they're in trouble. So we'll talk more about the regional banks in a moment. I'm kind of getting off here, but Talon, you were exactly right. I don't think the market's going to respond to it because we have way too much news coming out this week. I think they're going to ignore it until it's really the only topic that can be stared at in the face. Hey, Sean. Welcome, brother. Okay. All right. No worries, Mike. TZ Burton, welcome. Yeah. So right after this live stream, I had to get on with GoDaddy. They're supposed to be doing a restore on the website. I didn't update. We had an issue with the membership software. I did an update and it crashed the site. So I'm on with GoDaddy. I have a thing with them like 7:15 this evening that I cannot miss. So it should be up and running by tomorrow. Philadelphia Regional Bank Republic, first we'll see, but yes. Yep. And we'll take a look at the KRE in a moment. That's the regional bank ETF. Earnings coming out. We have a lot. As Mike mentioned, SoFi in the morning. We have energy stocks coming out in earnest this week. You have Transocean coming out after hours. Lots of semi names Rambus coming out after hours on Monday. Tuesday, big day. You have some Dow names coming out. Coca-Cola, McDonald's, Microsoft, I'm ready to say. 3M, Eli Lilly, PayPal, Amazon after the close on Tuesday, AMD after the close Tuesday, Supermicro, Starbucks, Pinterest, Lemonade. Members, I'm going to be talking about Lemonade in a moment. Actually, I'm going to do a separate video tomorrow. I'll release it to everyone, but I'll give the trade details that I plan on putting on with Lemonade into earnings. I rarely do this, but into earnings, I'm going to be putting on a trade. Pfizer on Wednesday morning. Barrick Gold, that should be interesting. MasterCard. Qualcomm, more semi names after the close. Devon Energy, Carvana, Fastly, Etsy. Moderna on Thursday morning. Coinbase, Apple comes out after the close on Thursday. Block, formerly known as Square. DraftKings, Cloudflare. Booking Holdings, Expedia. Friday, more energy names. Cheniere, Hershey. A big, big week. So buckle up, folks. There's going to be a lot of volatility in this market. Now, earnings came out last week. Really good, right? Google, Microsoft, good earnings. Equities are no less expensive than what they were this time last week. They're very, very expensive at 33.86% versus the mean of 17.11. So we can look at these earnings reports and we can say, okay, equities are getting cheaper. No, they're not. They're not getting cheaper. The stocks are responding to the earnings. They're moving up higher and they're dragging the multiples up along with them. Microsoft is not cheap on a relative basis. Now, Peter St. Onge, he's a great guy. Re-accelerating inflation could set off another series of bank collapses as markets realize the Federal Reserve does not have the balls to end inflation. Another great deep dive for FX hedgers. Check it out. I love this meme. Give me that big money printed energy, Jerome. She needs another $2 trillion. Good old Jen. She's a clever little lady. She's been spending a lot of money over at the Treasury. This was just shared on our Slack forum. I didn't have time to digest it, but it looked interesting. Federal Reserve Open Market Committee meets this week and faces the ultimate decision regarding the creature that they have unleashed on global economies. Do they continue stagflationary policies or initiate a financial crisis by actually ending the era of easy money? I can tell you right now, presidential election year, there is no way on God's green earth that this is going to happen, because this is Armageddon for equities. Armageddon. Endgame. Over. Finito. The equity markets will vote this week before the April 30th to May 1st meeting. And if HYG is any indication, the Fed will vote to maintain higher inflation for longer. And here's the chart. So yeah, I agree with that. They are going to let inflation run hot. Here's a supercore inflation. This was released on Friday. We now have 2 straight months of higher PCE, PPI, CPI, and supercore inflation. NQ just broke to session lower lows. Let's see if there's any volume behind this. There doesn't appear to be. Let's check out yields, see if they're responding to a recovery in yields. Nope. Yields are rolling over. They broke to lower lows. Okay. So it's no wonder that the expectation for an ease is now really it's fading. It's fading. You're going to tell me that we have hot inflation data in November, similar to what we saw in the PCE report this past Friday? We're going to get a rate cut in December? I don't think so. Commodity prices. I'm not going to read all this, but a chart speaks 1,000 words. U.S. commodity price index 10-year rolling. We're in the early stages of a major run here in commodities. And that includes gold, because the dollar has been strong, very strong. Yet commodities, which are primarily priced in U.S. dollars, what have they been doing? They've been going up. They haven't cared. Granted, we had a little bit of a lull in the agriculture and corn, wheat, soybeans. Yet cocoa prices, coffee prices, they're all moving up. Orange juice prices, eggs. So let's take a look at the materials ETF. What did it do last week? Bullish key reversal bar. This is a continuation pattern. The Dow Jones mining sector. This is a monthly chart. Month is almost over. Nice breakout on the month out of this downtrend channel. This is a multi-year downtrend. It's now very close to being over. I would call a close above 119.78. Finito for the bear market. We're now entering a new bull market. Crude prices. They broke out several weeks ago. They failed to hold the breakout, but last week, inside week, no new high, no new low. And it appears as though they're getting ready to attack that resistance level yet again. So oil prices holding firm. Food prices, we already went over this. So last week, you saw the DBA pull back. What is 10% of the DBA? 10% of the DBA is cocoa prices. But cocoa prices corrected 7.5% after this ridiculous bull run. But we also know that wheat had a breakout last week. Corn had a breakout last week. Soybeans had a breakout last week. So it's going to take time for them to build momentum. But when they do, you're going to see this correction that's probably going to continue for a couple of more weeks here on the DBA, settle down, and then set up for a continuation breakout. Gasoline prices, bullish key reversal bar on the week last week, inflationary. GDM, this is the gold mining index. Now, the gold mining index is extremely impressive. So we remain, believe it or not, after the nice bull run that we've had, we remain in a bear market. It's not over. This is a monthly chart. We're in a bear market. I would call this a secular bull market, but we are in this is a cyclical bear market inside of a secular bull market. So basically what I mean by that is that we are in a macro bull market. However, for the past 4 years, we've been in the secular bear market, a smaller short-term bear market within the greater context of a bull market in GDM. Similar to what we saw in 2022 in the equity markets. We're in a big bull market, but we went into a cyclical bear market. So I think that we're getting ready to break out here. And what's very impressive about the strength of the gold mining stocks is that the dollar, which I have correlated here, GDM versus US dollar in green, the dollar is strengthening, but so also are the gold mining stocks. The correlation, while still negative on a macro basis, on a shorter term basis, is correlated. This is not going to last for long. It never does. Geopolitical events cause this to happen usually. So I don't think the gold stocks are out of the clear yet. I don't want to go adding more. I'm happy with my position at current, but it's looking very good, especially if the dollar rolls over. Here's the dollar. And I don't think that the dollar is going down right now. I think it wants to go up. This is a breakout. So that's why I'm a little bit nervous about gold right now, a little bit nervous about the gold mining stocks. I'm not going to sell. However, I'm not going to get overweight either. I need to see the dollar pull back. If the dollar's pulling back and going down, I want to buy all the gold stocks I could possibly get my hands on. So I talk about the yield curve quite a bit, and you're seeing it talked about, twos versus tens. You're seeing it talked about quite frequently now, and maybe I've been chicken little for a little bit too long here, but clearly the yield curve is signaling trouble ahead, and it's starting to get picked up by other names out there. So Game of Thrones, they posted it, and we've been talking about this for a long time. There's nothing today that tells us the Fed has successfully achieved a soft landing. True. Experts are much too early in calling for that scenario. True. But they're going to do it anyway. They're going to do it anyway. Why? Because the financial news media wants you buying stocks. Because they know if we go into a bear market, their viewership declines. It's a fact. They want you buying stocks. They want you bullish. They want a bull market. Simple as that. End of statement. The yield curve steepening is when we'll see the real damage that was done from the tightening. Bravo. Exactly right. Probability of a recession later this year is extremely elevated. I don't know about that. I don't know about extremely. If this is right, if this November, December ease probability stabilizes, stops going down, and begins to increase, then I'll go into that ballpark of saying, okay, you know what? We have a problem. Houston, we have a problem here. Because again, the Federal Reserve only cuts rates when they have to. They're responding to a crisis that is a crisis of their making. And the only thing they know how to do is cut rates aggressively. And this time they're going to go hog wild because it's a presidential election year. Now, we spoke earlier, and this could be the precursor to what's going to set the yield curve going off higher. U.S. small bank cash reserves plummeted by $258 billion last week, below the level considered a constraint, according to Zero Hedge. This excludes a $126 billion still sitting at the Fed's emergency lending program. I mentioned that earlier. That is expired. It marked the greatest decline in bank deposits since April of 2022, when $336 billion came out of the banking system. We all know what happened then. Stocks went down, regional banks went down. Meanwhile, U.S. regulators have seized Republic First Bank on Friday and agreed to sell it to Fulton Bank, another regional bank with $6 billion in total assets. That's pretty small. That's small. The FDIC projects that the failure will cost the fund around $667 million. The regional bank crisis appears far from over. Let's see how the KRE did last week. The KRE is the regional bank ETF. Now, it closed up, but it faded off the highs of the week. What did it do on Friday? Friday looks like not a good day. Down over a half percentage point. So this is not a horrific chart, but I suspect that they're going to see some pressure on this sector yet again this coming week. Now that the markets overall may ignore this seizure of this bank, the KRE is not going to ignore it. Buyers of the KRE are not going to ignore it. They're going to sell because that Fed lending facility expired in March. Who's got the back of these banks? Is this going to become every Friday event after the market closed, they run in and they seize a bank. That's only going to last so long before the markets begin to respond. I found this interesting. Just in, 43% of small businesses in the U.S. were unable to pay their rent in April, the highest share since March of 2021. Delinquencies are largest amongst restaurants at 52% that became delinquent in April. More than 50% of small businesses claim that now rents are higher than 6 months ago. Meanwhile, nearly 60% of the firms founded after the pandemic report that they are earning less than a year ago. So stagflation. Prices are going up. Business is, they may not be losing money, but they're not making money as they were a year ago. That's stagflation. That's the perfect petri dish for gold and silver. Inflation, rising inflation and shifts in consumer spending are crushing small businesses. We know that. We take a look at the IWM, we take a look at the mid caps, and they're not doing well. Small businesses are the backbone of the economy, no doubt about it. So here you have it. Delinquencies are rising. With a steepening yield curve. I'm going to go to my own chart of this one. We'll skip this. China deflation. They're predicting they have deflation there. They're predicting that they're going to need to devalue, and they've done this before. I think it's the renminbi, their offshore currency. So expect a rally in equities. In fact, it's already begun. Equities in China are going to rally. So let's talk about that for a moment. This is the iShares MSCI China ETF. Massive breakout out of a downtrend channel last week. I think any pullback here could be bought. Now, I'm not a big believer in investing in China. I've said for years, ever since COVID, it's uninvestable. I would only use discretion. I would consider it a very high risk trade. So if you want to lose 100% of your money, which is absolutely possible if they do an invasion of Taiwan, consider any equities that you own here that are Chinese wiped out. Remember what they did to the Russian ETFs and Russian stocks here in the United States once they invaded the Ukraine. Within 2 weeks, they were worth zero. They're going to do the same here if they do anything with Taiwan. So that being said, a massive breakout on MCHI. And if you want an individual name, Alibaba looks awesome. It broke out as well. I suspect on both of these names, we're going to do a retrace back down to this lower band of support. I think that these are going to get resolved, absent some geopolitical nonsense out of China. They're going to get resolved to the upside. So bullish on China. I haven't been for quite a while. The charts are saying get bullish. Therefore, we're bullish. Let's do some comments. Jeff, SPY and QQQ looks like they have a double bottom pattern on a daily chart. Let's bring it up. QQQ. Daily chart. I see what you're saying. And the thing with technical analysis is that it's like a Rorschach test at times, right? You look at this chart. What do you see? You could see a bat, and I could see a butterfly. So you need to just be very, very humble, right? Because you don't want to talk yourself into a trade. I'll say this: I see something different than you do, but that doesn't mean you're wrong. You could ultimately be proven right. How do we measure whether or not you're right or wrong? It's very, very simple. You take a crayon out and you draw some lines. And once they cross, like you put a line in the sand, dare to cross that line. If it crosses that line, meaning the stock market, Qs, SPY, individual stock, and it closes there, and you didn't think it was going to do that, well, you're wrong. Say you're wrong, and you're done. Get to the long side or get to the short side, whatever the chart warrants. So in this case here, what Jeff is alluding to, and correct me if I'm wrong here, Jeff, is that Jeff is saying this, is that I believe, and correct me if I'm wrong here, there's your W formation. I don't see another one on here. Now, a W formation, maybe, and you had a continuation move up higher on Friday confirming that pattern. Okay, I'll give you that, maybe. But what we need to do first is we need to get through some really serious resistance, right? Until such time as we close above this resistance level here at 432.35, I see this. Because remember, we had a rounding top on the triple Qs. Then we broke major support. Now we're back trying to recapture it. Do we do it? Maybe. What I see is this. Bear flag setup. Simply put, this downtrend was too extreme, too quick, and it needed to have some pressure release, a short covering rally. Remember, you had a big move on the Qs, 1.5% move on the triple Qs on Friday. How was volume? It was horrific. It was horrible volume on Friday. So until such time as we recapture major support, which is immediately above, we tested it on Friday, but we were rejected. I still think that we are in a downtrend in the equity market. Now, if we close above that mark I just spoke about, then I'm wrong. 100% wrong. No shame. The only shame is when you don't admit you're wrong and you let your losses run. So then we get long. Simple as that. Okay, we have Sean wants Ulta. Mike, we'll take a look at Meta. I'm interested in that one myself. SE for Joel. Falcon. You know, Falcon, I just remembered you sent me an email. I got to reply to you. I owe you an email response. Hey, Bob, did you read the article of B of A and Chase writing low $4.5 billion in credit card defaults in 2024? I think so. The personal savings rate in the United States is at depression levels. So we haven't been at these levels. The last time we were there was in 2020. And before that was like the Great Depression. So yeah, people are going to be borrowing on their credit cards as long as they can. And ultimately, until those credit lines get shut down, they're gonna spend them out. And the banks, they're collecting over 20%. So don't feel too bad for them. They're still making a heck of a lot of money. But I think you're right. It's a drop in the bucket. Okay, let's get to it. Let's do some charts. FCG. First Trust Natural Gas. Whoa, look at this one. This is interesting. Let's go to I've never gone over this one. Monthly chart. Beautiful chart here. Great pick, Franklin. Let's do this. As a matter of fact, let's do this. FCG. And let's do a correlation to natural gas. Good to see. Okay, so there's an inverse correlation to natural gas, but they can be correlated at times. Okay, I like this. I think that this is a screaming buy. So what you have here is breakout number one. Then you have a higher low. Then you have breakout number two. We're above a volume shove. You have the Bollinger Bands in black inside the Keltner channels in green. So this is setting up for a short squeeze. It's already seen one, took a pause, bullish reversal bar. This is going up. I think this breaks out. I think it breaks out. You have your moving averages, which are stacked positive. You have a great macro monthly chart. The longer the consolidation, let's go back to that chart. The longer the consolidation, the greater the validation of any breakout. This is a multi-year consolidation, and we are breaking out. Bullish. Great pick, Franklin. Ulta for Sean. So Ulta has had its problems. The monthly chart is not good at all. The weekly chart, you may get a bounce here. Yeah, I think you may get a bounce here. I wouldn't short it. I'm not a day trader, so I wouldn't buy this. I don't see the edge here. No breakout yet, but I do think that any day you're going to get a counter trend rally. But in all probability, they're going to sell into that rally. So as a long-term investment or a position trade, I don't see it here. I think that they're probably going to lean into the short side on any rally and take it down lower because that's where the path of least resistance is. So that's my take on it. I would avoid this one as a long. Meta. So Meta reported 2 weeks ago now, nearly 2 weeks, and no bueno. The monthly chart looks horrific. You have Zuckerberg. He's been selling for 2 quarters now. We broke massive support last week on volume. I think we're going a lot lower here. I think on a daily chart, what you're seeing is simply a dead cat bounce. I would be if they rally it up and into 460, 461, that area, I would be a call seller. Let's see how expensive the options are on Meta. They're still healthy. There's still a lot of juice in these options. So I would be a call seller here on Meta. And I would wait to sell the puts. I would first wait for it to hit resistance, sell a call spread into resistance, 20 delta, 15 delta, and then As it begins to roll over, takes out lower lows, then you start looking to sell premium to the put side. So I would not sell puts here right now. I think that it's going to roll over. It's going to break the new lower lows. And put sellers, those who think that this is done going down right now, they're going to get hurt. So I would not sell puts here. I would not buy this stock unless you're just going to swing trade it up to 460. Where do we close on Friday? 443. Can they pump out another 20 points here? I guess. But ultimately, once we break this lower band of support, which I think we're going to do, I'm a call seller here. That's what I'd be doing. I'd be taking advantage of the implied volatility. I'd be getting short of Meta. SE. Monthly chart. Very, very nice setup here. We have a Bollinger Band squeeze forming in black. You have your Bollinger Bands. Can I make these thicker? Let's try that. Yeah, there we go. Perfect. So the Bollinger Bands are inside the Kellner channels in green. This is setting up for a short squeeze. Weekly view, and it's already begun. We broke out. Daily chart. A little bit extended here, but I think ultimately this is going up. My daily chart on Thinkorswim looked differently from Meta compared to Bob's daily chart. Okay. Well, my chart of Nat Gas looked different than it did on the weekly chart of Nat Gas looked different than what it did on stockcharts.com. Which one is breaking out? You have FCG, which is breaking out. Ulta and Meta, I think, go lower. SE, I think, goes higher. But it hasn't had the big macro breakout yet. On a weekly time frame, it has. So what's broken out? SE and FCG. Okay. All right, all. Thank you for being here. Have an awesome remainder of your weekend. Like, subscribe. You know the deal. Have a profitable trading week, and I will talk to you soon.